Okay, generally, I'm not a real big fan of Mondays. I like to see other traders go out there, put their neck on the block, and then see what the general consensus and sentiment is on a given week where we don't have non-farm payroll. Okay, so if we have non-farm payroll, I'm interested in trading on Mondays. Every single Monday that has non-farm payroll Friday, I'm trading and engaging on Mondays trading. I'm absolutely looking for moves to do, something that gets me into a trade. Generally, I'm not interested in Mondays otherwise. And because of that, I'm trying to counsel my son and his brothers, if they watch these videos too. I'm hoping it will inspire them to do it as well. But they shouldn't be trying to trade on a Monday in the morning session ahead of PPI and CPI numbers like we have here. So if there's ever a real big, huge neon sign that says, don't really try to trade on this, because I know a lot of my students will say, and a lot of people that don't like me, or they try to troll me for clicks and views and ad revenue or attention, they'll say ICT never trades, or he says never trade on Monday, and then they'll show their after the fact trade, and they'll say this is what I did, and that's great, well, kudos, but there's a lot of things I don't personally want to do as a trader, and other people do, and they make money. I'm not arguing that, but what I'm saying is because you're here watching my content, the interest is you're wanting to know my opinion or what I'm thinking or what makes me tick about an idea about a market going higher or lower. And what do I look for in terms of a trade idea? What do I look for a setup? Okay. Or when do I try to avoid taking those trades? It's important for my son to know that it's problematic on days like this because, number one, it's the morning session. Everybody's chomping at the bit to do something. And large pools of liquidity, big players in the marketplace are not going to position this morning because they know what's waiting on Tuesday and Wednesday. So because of that, just know that you're going to see a lot of this type of action where it's up, down. It's real skittish, meaning that it goes up, it goes back down, it goes back up, it goes back down, and it becomes very, very sloppy real quick. And it becomes almost seek and destroy like. Now, what is seek and destroy? Seek and destroy is where the market will go just above a short-term high, just to go back lower to take out a old short-term low, and then come back up, take out that short-term high that was just formed, and then vice versa. It'll go back and forth, and it kind of runs you over, even if you're in a position, as you saw here at the opening of the stream. Even though I can be right in the direction, and I can see where it wants to potentially go, here we are, it can still come back and take me out. Now, if it wasn't a Monday with the PPI and CPI numbers coming out on Tuesday and Wednesday, I would go back in and short up here. But because it's not conducive for that, because we have huge news coming out Tuesday and Wednesday, I know that the probabilities are likely. Didn't think I saw that coming, did you, Phil? The high being bumped there and then trading lower. Here is the new week opening gap high. So the bias, as I was teaching last week, here's your new week opening gap for this week. We had price above it. It rallied up. It took liquidity. And where's the draw going to be? Where's that like black hole of just constant tension and pressure to pull price? Caleb, it's the new week opening gaps. Okay. So if we have that and we have an old new day opening gap here, we'll have a new one tonight when 5 p.m. comes, and then we have the opening at 6 p.m. We'll create another new day opening gap. But right now, we have to work with new week opening gap and old. Remember I told you last week that the new day opening gaps have a shelf life or life cycle. Not that it's limited to 5 days, but if you work with them in that perspective, you'll see how the market uses this idea where it gravitates back and forth towards these levels. They're inefficiencies that will be used again, like a magnet will draw price to it. So when we're looking at bias, these are going to be your first central tenets to trying to derive what that bias is. So if we know that the new week opening gap is here for this past Sunday or yesterday evening, 6 p.m., in relationship to, I guess if I scrub over here, you'll see. Well, we'll come back to it in a second. It's less than 20 handles, so therefore I'm not really interested in annotating the quadrants inside of it. You can eyeball it. It's about halfway here, and the upper quadrants here and lower quadrants there. And if it can trade through that, and then we go back into new day opening gap of the 9th. Okay, so that's Friday's new day opening gap. That would have been formed and calibrated from Thursday evening, New York local time. It's Thursday's 5 p.m. closing price and settlement, and then 6 p.m. 1 hour later, new session opening. So between those two price points, you get it here. And again, it's not annotating the quadrants or the midpoint because it's less than 20 handles. Okay, so if we have a previous new day opening gap below price, and we have new week opening gap here, and the market was made jagged here, and we have inefficiencies that we're respecting it, the market's going to do what at the opening bell? It's going to gravitate in the direction of these old inefficiencies because the market is algorithmic. So it has to refer back to those same things I was teaching last week. So that way we're not sitting here staring at book map charts, okay, or things like that and talking about nonsense. And the whole time the market's moving and not having had a trade or even knowing the bias. There you go. So you want to screenshot that, okay? You want to screenshot it again and put it on your calendar. The ICT was talking about this stuff last week and talked about it live, coming back up and just bumping this high here and then ripping it down. Here's your open, trades back up, touches the bottom of the inversion fair value gap. That's a trade, not on a day that's ahead of PPI and CPI. And the market rips lower, eats right on through all of the layered liquidity here, upper quadrant level, trades lower, and look at the bodies, how the bodies are stopping right new week opening gap. See that? Isn't that beautiful?